Hello and happy Friday, fellow real estate nerds. Welcome to this week's Gig Harbor Market Update. We're going to be talking about the Fed and what they have been telling us here at their Jackson Hole meeting that just happened. So let's look at what the Fed is planning for our economic future. Last year's meeting at Jackson Hole was quite something else. I mean, the Fed just came out with all guns blazing, saying we're not even restrictive yet. We have to get inflation under control. We're going to pull out all the stops in order to do that, and interest rates are just going to go up. And sorry guys, we got to do something about this inflation. So that's what happened last year. This year was a very different story, different Powell. So what happened, he was very cautious and very neutral, I would say, when it comes to what kind of Fed policy we can expect going forward. So let's look at what he said exactly to understand what's going to happen over the next several months here and perhaps over the next year. During Powell's speech, he essentially told us that we're getting there, but things could break. And that could word was used several times with explicit emphasis during Powell's speech, of course. And I think this was a way of priming the market, saying we don't have a clear direction as to where we're going, and we're just kind of flying by the seat of our pants here. So we have no clear prediction or clear direction, and we're just going to say, let's take it and see what happens. Hopefully things don't break, and we'll just see if inflation meets expectations. So let's look at some excerpts from what Powell said directly that contained the word could, and just to get a glimpse of what the Fed is considering here when it goes forward with their monetary policy. All right, let me pull these excerpts on the screen here so you can read them for yourself. The first one says, we expect, let me highlight for you. We expect this labor market rebalancing to continue. Evidence that the tightness in the labor market is no longer easing could also call for monetary policy response. So basically they want to see unemployment go up, and if it doesn't, they could raise rates. Next one, additional evidence of persistently above trend growth could put further progress on inflation at risk and could warrant further tightening of monetary policy. So now we have two coulds. So even if additional persistent growth above trend growth, that could happen, but they might not do any monetary policy. So everything's like, it could happen, it could do this, it could do that. And it shows you how little direction that the Fed has right now, and they're just kind of winging it. Okay, the last one I like to pull out here was doing too little could allow above target inflation to become entrenched and ultimately require monetary policy to wring more persistent inflation from the economy at a high cost to employment. Doing too much could also do unnecessary harm to the economy. So again, that could is becoming a huge policy now going forward. Nobody quite can predict what the Fed is going to do because everything is a could scenario. So as it says here, I wrote, this is a lot of conditional statements. Unlike the previous message from Powell, so this was from last year, we must go higher, we must increase interest rates in order to combat inflation. This time he's basically saying that if things get worse, we could do monetary policy. So let's look at some indicators real quick to see what has been happening in the overall market here that the Fed is looking at. And just like that, it's nighttime and a different day. Sorry about that. Anyway, let's get back to the economic indicators here. The University of Michigan, the Consumer Sentiment Index declined a little bit to 69.5. It was expected to come in at 71.2. So that's from the Fed's point of view, that's a good thing. They want the economy to slow down and to get crushed a little bit under interest rates. 1 year inflation expectation has ticked up a little bit, so they're hovering between 3.3 and 3.5%, which is higher than the Fed's 2% goal. And the 10-year Treasury yield hasn't moved at all. It's still relatively flat, and markets currently are still positive as people are trying to digest this Fed meeting. So right in here below, you see in your screen is the from the University of Michigan. Basically shows consumer sentiment, and you can see that we are trending up after our little bit low here before 2023, but it's starting to trend down again. So, well, it's coming in less than expected. So that's what we are. So As I said, my email is kind of a mixed bag in terms of Fed cues. It's on one hand, the Fed is getting what they want, and on the other side, they're not quite achieving their targets. Speaking, I mean, just from the inflation point of view, but at least the consumer sentiment is going down, which is good in terms of the economy overheating. So the Fed doesn't want that. So at the end of Powell's speech, he had a really amusing quote, and I think that kind of sums up everything the Fed is doing. And here it is. And to quote, "As is often the case, we are navigating by the stars under cloudy skies." And if you've ever been on trying to navigate anything, you can't go by the stars if you can't see them. So that's kind of the Fed's just basically saying we have no idea what's going to happen. So we're just kind of winging it, guys, and we're going to respond as things kind of pop up. So things seem okay at the moment, but there are risks in the current situation. So that's what the Fed is. They're just kind of letting things kind of unfold, so to speak. So it is a world's, a huge difference from last year. What Powell was saying. Again, I want to read these quotes off. He did not say the historical record warns against premature loosening, or, quote, we have to force demand and supply into balance. This time he said that demand is continuing to go up, but if inflation doesn't unanchor, it could be okay that demand goes up. So, and the Fed won't be so heavy-handed in trying to match supply and demand to bring prices down. So just to recap kind of that last year's difference between this year's, then Powell said the labor market is clearly strong, and now he says the labor market is definitely coming into more balance, but there's still work to do and that could change, but it's trending in the right direction. Okay, then we need to be more restrictive for some time, and now we've been restricted for some time. So the Fed is loosening up their tone. And last year they were talking about irrational inattention. And that's basically if inflation is stable, people and businesses don't care or worry about inflation that much. Yes, it's there, but it's not, this lingering problem. But when inflation is unstable, that's when people and businesses are distraught and they start pricing in more inflation. So that's why prices keep going up and up and up. People are saying, okay, we'll have to deliver this product in 6 months. What's the price going to be in 6 months? I don't want to have to pay to essentially deliver a product or service. So that's when they're still more worried about inflation. And now he didn't mention Paul Volcker anytime during the speech, which is a great sign because if you don't know, Paul Volcker was the Fed chair during the 80s when he really had to crack down on inflation by jacking up interest rates. And that was some tough love from the Fed. So that's good that he didn't say anything that. So the bottom line I want to say is this was a very cautious Fed meeting. Powell didn't want to create a stock market rally, nor did he want to create a stock market crash. So they were just saying, hey guys, we've come as far as we can with certainty, so now we're just going to see how things play out, and don't expect too much change over time. However, I would like to note that I don't see interest rates coming down, at least the Fed coming down on their interest rates anytime this year. So if you've been waiting, you're gonna have to wait some more. I think most professionals I listen to suggest maybe 18 months is when we're gonna see any sort of return to 5%. But of course, the flip side is when it comes down to 5%, there's going to be a lot more buyers, and people are expecting like housing prices could go up by 10% just because of the interest rates coming down. So it's kind of kind of stuck between a rock and a hard place, really, if you don't have cash. So right now you could just be saving cash and hope of black swan event kind of brings down prices. But if that doesn't happen, then I don't know. It's tough right now. So, but yeah, that's it. That's the Fed meeting recap between a year ago and now, and what does it mean going forward. Basically, the Fed is just gonna kind of sit back and relax and kind of take things in stride because they don't know what they're doing. So, anyway, hope you enjoyed this, and I'll talk to you next week.